Car lots are full, but buyers? Nowhere to be found. Auto loans are skyrocketing, interest rates are brutal, and those record-high car prices? Yeah, they've finally come back to bite. Dealers are begging, inventories piling up, and Americans, they're tapping out. Is this the end of the American car dream, or just the beginning of a total industry reset? Today, we're breaking down what's really happening in the car market, and why nobody is buying anything. The American car market is facing a perfect storm that's quietly unfolding beneath the surface headlines. After several years of inflated prices and record-low inventory, the tides are shifting fast. Currently, interest rates on car loans have surged to their highest levels in over 2 decades, with averages hovering around 7%, 9% for new cars, and often well above 10% for used ones. This spike in borrowing costs, driven by the Federal Reserve's aggressive rate hikes, has priced many consumers out of the market. Meanwhile, dealership lots are beginning to refill, reversing the pandemic-era shortages. But even as inventory returns, actual vehicle sales are stalling. Consumers squeezed by inflation, rising insurance premiums, and economic uncertainty are holding back on big-ticket purchases, especially non-essential or luxury models. What's more, a growing number of buyers are underwater on car loans taken during the pandemic peak, discouraging trade-ins and further dampening demand. Over the next 6-12 months, this divergence between inventory and demand could lead to sharp price corrections, increased manufacturer incentives, and potentially even dealership closures or consolidations. While automakers remain tight-lipped, the signs point to a looming shakeup, one that could redefine how Americans buy, finance, and value their vehicles. Are we in the middle of a car market recession? The data and the silence from automakers strongly suggest that we are. The car-buying frenzy of 2020 to 2022, fueled by pandemic-era stimulus checks, supply chain disruptions, and historically low interest rates, created an artificial bubble in both new and used vehicle markets. Automakers slashed production while demand surged, driving prices to all-time highs. Now, in 2025, the bubble has burst. Used car prices have dropped significantly, stranding millions of consumers in negative equity. New car prices, while leveling off, remain prohibitively high, averaging over $47,000, due to ongoing material costs, electrification investments, and bloated trim options. What's worse, the average interest rate for auto loans sits above 8%, making even moderately priced cars financially inaccessible for many Americans. This affordability crisis is hitting at the same time household budgets are stretched thin. While inflation has cooled somewhat, wage growth hasn't kept pace, and higher costs for essentials like housing, food, and insurance have left consumers with little room for a car payment. The average monthly payment for a new car is now well over $750, with used cars not far behind. For many, buying a vehicle simply doesn't make financial sense, especially when reliable older cars can be maintained for far less. The impact on the auto industry is already visible. Major automakers have begun slowing production, scaling back EV expansion plans, and offering increasingly aggressive incentives just to move inventory. Dealerships, particularly independent and rural ones, are facing shrinking profit margins and rising floor plan costs as unsold inventory sits on lots. Many are resorting to deep discounts, flash sales, or even layoffs to stay afloat. Looking ahead, the next 6 to 18 months may bring a transformation rather than a recovery. We're likely entering a new era where traditional car ownership loses ground to subscription models, long-term leases, ride-sharing, and mobility as a service options. Younger consumers, already disenchanted with debt and wary of long-term financial commitments, are opting out of the car market altogether. Unless the industry adapts to the new affordability reality, this downturn could accelerate a generational shift in how transportation is bought, sold, and perceived in America. Over the last 3 years, the American car market has inflated to unsustainable levels, and now, much like the housing collapse of 2008, it's unraveling in real time. Between 2021 and 2023, consumers watched car prices skyrocket amid pandemic-related supply chain issues, semiconductor shortages, and a flood of stimulus money. Dealers couldn't keep cars on the lot, And buyers, fueled by panic, low interest rates, and a buy now or pay more later mentality, rushed in, often paying well above MSRP. This irrational exuberance created a textbook asset bubble, inflated prices detached from long-term value, mass over-leveraging, and the illusion that prices could only go up. But that illusion has shattered. In 2025, car values, especially used ones, are plummeting, and reality is setting in. Consumers who paid peak prices are now deep underwater, owing far more on their loans than their vehicles are worth. Repo rates are climbing at a troubling pace, particularly among subprime borrowers, and auto loan delinquencies are at their highest levels since 2009. The industry is facing a financial reckoning, with lenders tightening credit standards and pulling back on approvals just as many. Borrowers try to refinance or offload unaffordable vehicles. For some, it's already too late. At the same time, dealerships, once beneficiaries of record margins and limited inventory, are now showing clear signs of distress. Incentives that were unheard of a year ago are flooding back. Zero-down offers, extended loan terms, deferred payment plans, and manufacturer-backed rebates. Floor plans, the financing dealers use to stock inventory, are becoming costlier, leaving smaller operations especially vulnerable as interest accrues on unsold cars. Lot sizes are swelling again, but the foot traffic isn't returning. Buyers are wary, waiting on the sidelines for prices to crash further, which is fueling a vicious cycle of depreciation and desperation. All this points toward a broader correction, not just a temporary dip. What we're seeing is not just the result of economic tightening or consumer fatigue, it's the collapse of a bubble built on easy credit, psychological urgency, and supply-driven scarcity. And like housing in 2008, the effects will ripple across industries. Financing, manufacturing, insurance, and even tech, especially EV startups, could all feel the shockwaves. The American car market is not just slowing down, it's entering a full reset. The only question now is how deep the correction will cut, and how long it will take before trust and true affordability returns to the market. What's happening in the car market right now is a seismic shift, not a seasonal slowdown. The average American isn't just delaying a purchase, they're opting out entirely. And it's not because they don't need a car, it's because the entire system has become unsustainable. While the Fed's high interest rates have made borrowing more expensive, that's just the tip of the iceberg. The real issue is that overall affordability has collapsed. Americans are dealing with the highest cost of living in decades, from groceries and rent to healthcare and insurance. Car ownership, once considered a staple of adulthood, is now seen as a luxury for many. Even with steady jobs, consumers are hesitant to take on a 5 to 7 year loan with a $700 to $1,000 monthly payment attached, especially when their current vehicle, though older, still runs fine. Automakers have made the mistake of treating the pandemic-era boom as the new baseline. They overestimated long-term demand, especially for electric vehicles, and scaled up production aggressively. Now they're paying the price. EVs in particular are piling up on dealer lots, many with price tags that simply don't match consumer sentiment or practical needs. Despite generous federal incentives, the average EV buyer is still wealthier than the general population, and the promised mass adoption hasn't materialized. Meanwhile, traditional gas vehicles haven't gotten any cheaper either. Automakers have focused on high-margin trims and larger models, ignoring the entry-level segment, effectively pricing out younger and lower-income buyers. At the same time, the financing landscape has turned hostile. Banks and credit unions, wary of rising delinquencies and falling used car values, are tightening lending standards. Approvals are harder to get, down payments are higher, and those with anything less than excellent credit are often offered sky-high rates. The result? Even people who want to buy are being locked out, but smart consumers are adapting. They're turning to private sales, downsizing to one-car households, delaying purchases by investing in repairs, and exploring alternatives like ride-sharing, e-bikes, and car subscriptions. Many are waiting for what they sense is coming, a deeper price correction. This shift has massive implications not just for automakers, but for the entire ecosystem around vehicle ownership. Dealerships, lenders, insurers, repair shops, and even local governments that depend on vehicle taxes. If consumer behavior continues in this direction, the industry may be forced to rethink its core assumptions about demand, financing, and what kinds of vehicles people actually want. The age of automatic upgrades and trade-ins every 3 to 4 years may be over. What replaces it could look radically different and far more frugal. In 2021 and 2022, new vehicles barely touched dealership lots before being sold. Buyers were lining up, paying over MSRP, and competing for limited inventory. Fast forward to 2025, and it's a different story. Vehicles are gathering dust. According to industry data, the average days on lot for new cars is steadily rising, with some models sitting unsold for over 6 months. Trucks, EVs, and high-priced SUVs are the hardest hit, and even once-hot mainstream models are languishing. The average inventory supply now exceeds 70 days for many brands, with some dealers reporting well over 120 days for specific trims. This is well beyond the 45-60-day healthy range the industry aims for. Behind the scenes, dealers are sounding the alarm. One East Coast GM dealer said, "We've got too many of the wrong cars. High-priced trims nobody wants in this economy. I've got EVs I can't give away." A California Ford dealer shared, "The demand isn't there like it used to be. People are tired of paying top dollar for vehicles that aren't worth it. We're negotiating again. We haven't done that in years." These are just a few examples of a growing disconnect between what automakers are building and what buyers actually want or can afford. Consumers, now wiser and more cautious after years of inflated pricing and economic uncertainty, are holding off on major purchases. Many are waiting for bigger discounts, watching interest rates, or simply choosing to keep their current cars longer. The psychology of the market has shifted dramatically. Buyers no longer fear missing out. They're betting on a better deal around the corner. And for good reason. The combination of excess inventory, softening demand, and tighter credit conditions means price drops and incentives are not only likely, they're already starting to show up. Expect to see more aggressive cash rebates, interest rate buydowns, loyalty bonuses, and even lease deals re-emerging after a long absence. For savvy buyers with stable finances, patience is about to pay off. Those who can wait out the next 3 to 6 months may find themselves in the driver's seat, literally and figuratively, with the power to negotiate and choose from a wide selection. For the industry, however, this glut of unsold inventory is a flashing warning light. It's not just about too many cars. It's about a market that no longer functions as it used to. Automakers and dealers must adjust fast, or risk deeper losses in what could become a long, slow correction. The panic brewing in the showroom isn't just about moving metal, it's about survival. Many dealerships, flush with cash during the pandemic-era frenzy, expanded operations, stocked up on high-margin trims, and assumed the golden years of inflated demand would last. But 2025 has delivered a rude awakening. Interest rates remain high, lending is tight, and buyers have become sharply price-sensitive. That's forced dealers into a corner, where they're throwing everything they can at the wall. Multi-$1,000 rebates, free maintenance packages, deferred payments, loyalty bonuses, and even zero-interest financing, subsidized by manufacturers, just to drive traffic. It's a complete reversal from the take-it-or-leave-it attitude of 2021. And yet, even with all these deals, sales aren't moving the way they used to. That's because consumers are not only struggling financially, they're also skeptical. Many remember paying over MSRP just 2 years ago, and now see those same cars discounted heavily, leaving them with negative equity. Trust is eroding. Shoppers are researching more, negotiating harder, and walking away more often. The average days to sale is climbing, and floor plan interest, the cost dealers pay to keep cars on their lot, is eating away at profits fast. What used to be a valuable asset, inventory, has now become a liability, especially as depreciation accelerates on unsold models. Worse, some of the deals being marketed come with long-term strings. To get the lowest payment, buyers are often locked into 84-month loans with ballooning interest, or prepackaged add-ons like extended warranties and gap insurance that pad dealer margins. These offers look good on paper, but cost consumers more in the long run. And if this trend continues unchecked, it could trigger a cascading effect. more delinquencies, more repossessions, and further downward pressure on used car values, feeding the sense that the entire market is shaky. Ultimately, what we're witnessing is a car market correction in real time, and dealerships are at the front lines. Without a return to affordability, smarter production, and better alignment with real consumer demand, many dealers won't weather the storm. The flash sales and heavy discounts we're seeing now are just the early warning signs of a much bigger shift ahead. Right now, the car market is a perfect storm of high prices, expensive financing, and poor timing, and consumers who dive in without doing their homework are paying a steep price. With average new car prices still hovering near all-time highs and auto loan interest rates between 7% and 10% or even higher for subprime borrowers, the cost of ownership has never been more punishing. That $45,000 SUV may look tempting with a dealer cashback offer, but by the time you factor in the interest across a 6 or 7-year loan, you're potentially paying $55,000, $60,000 for something that will depreciate faster than ever. Even leasing, a go-to option for lower monthly payments, has lost its edge. Residual values are inflated, drive-off fees are up, and lease support from manufacturers is shrinking, making it harder to find real value in monthly deals. Used cars, which were once the safety valve for budget-conscious buyers, aren't the deal they used to be either. Prices have come down from their pandemic peaks, but they're still far above historical norms. And with loan rates on used vehicles typically higher than new ones, the savings often vanish on paper. Many used models are also aging out of warranty with questionable maintenance histories, putting buyers at risk of unexpected repair bills just a few months in. And with used car values softening month over month, buying now could mean owning an asset that loses thousands in value almost instantly. That's why so many savvy consumers are hitting pause. Some are returning to rideshare services for commuting, especially with the rise of car subscription apps that offer flexible access without long-term commitment. Others are dusting off bikes or e-scooters, particularly in cities where gas and parking are more of a hassle than convenience. For two-car households, consolidating down to one vehicle is an increasingly popular move, especially if one of those cars is paid off. Maintenance costs, even when rising, are still a fraction of today's average monthly payments. If you're asking when the time will be right, the answer is not quite yet. As inventory levels build and dealers become more desperate, real incentives, not just flashy marketing, will return. Used prices are expected to continue dropping through the end of 2025, especially if repossessions and lease returns flood the market. Meanwhile, if the Fed eases rates in late 2025 or early 2026, financing costs could normalize, opening the door to smarter deals. Until then, waiting, even just a few more months, could save you thousands. In this market, patience isn't just smart, it's essential. Drilling deeper into the data, the weakness in the auto market goes beyond just slowing sales. It's structural. According to Experian, the average auto loan interest rate for new cars has hit 9.7% as of Q1 2025, with used car loan rates exceeding 12% in many cases. The average down payment required to secure these loans has also risen to over $6,000, pricing out many middle and lower income buyers entirely. As a result, total vehicle sales in the US dropped below the psychologically significant 13 million unit mark on an annualized basis, down from 17 million just a few years ago. That's a collapse of historic proportions. Regionally, the Northeast and West Coast are still seeing somewhat resilient demand, thanks in part to higher incomes and more access to manufacturer leasing programs. But in large parts of the South and Midwest, dealer lots are overflowing. Data from Cox Automotive shows days on lot inventory has surpassed 100 days for several domestic brands in those areas, with full-size trucks and mid-tier SUVs struggling the most. In some cases, dealerships are offering as much as $7,000 off MSRP before manufacturer incentives just to get people in the door. On the automaker side, things aren't much better. Stellantis recently issued warnings to investors about weakening demand in North America, while GM and Ford are quietly scaling back production schedules for several 2025 models. Even Toyota, historically resilient, is sitting on more inventory, than at any point in the last 5 years. EV makers, too, are struggling with bloated inventories, particularly on models priced above $40,000. Tesla has reduced prices multiple times in 2025, but deliveries still missed expectations for 2 consecutive quarters. This downturn is closely tied to broader economic pressures. High inflation in essential categories like food, rent, and insurance is squeezing discretionary budgets. Add in the softening labor market and an overall dip in consumer sentiment, and car buying, already one of the biggest household expenses, starts to look downright risky. Leading economic indicators, including retail sales and consumer credit growth, suggest the trend may worsen before it improves. Looking forward, analysts from J.D. Power and Moody's project that unless interest rates fall meaningfully or real incomes rise, car sales may not rebound until late 2026. In the meantime, we can expect more aggressive discounting, especially heading into the second half of 2025, as automakers try to protect market share and manage the growing inventory glut. For consumers and investors alike, the writing is on the wall. The American car market is undergoing a painful reset. The electric vehicle boom that once promised to reshape the auto industry is now facing a harsh reality. Massive overproduction, softening demand, and growing consumer hesitation. In 2025, dealership lots across the U.S. are overflowing with unsold EVs, particularly in the $45,000 to $70,000 range, resulting in a supply glut that's distorting the entire market. Automakers ramped up production aggressively between 2021 and 2024, betting on continued government incentives, high gas prices, and widespread consumer adoption. But the demand didn't scale as expected. Now, models like the Ford Mustang Mach-E, Volkswagen ID.4, and even newer EVs from Toyota and Hyundai are sitting on lots for 100+ days, forcing manufacturers and dealers to slash prices, offer steep lease deals, and roll out massive cashback incentives just to clear space. Despite technological improvements and expanded charging infrastructure, many consumers remain hesitant. Concerns over range anxiety, long-term battery degradation, cold weather performance, and limited charging access in rural areas are keeping mainstream buyers on the sidelines. Even among environmentally conscious shoppers, the high upfront cost, despite federal tax credits, remains a barrier, especially with high interest rates making financing more expensive across the board. Compounding the issue is the fact that many EVs are still priced like luxury goods, while their perceived value hasn't caught up in the eyes of average buyers. Traditional automakers are now in a bind. Many diverted billions into EV development and factory conversion, sidelining or reducing their output of bread-and-butter gas models that still drive most of their profits. With EVs not moving and ICE, internal combustion engine, production scaled back, many manufacturers are stuck with bloated inventories and no winning hand. This misalignment is shaking confidence across the sector and even dragging down resale values. Used EVs have seen some of the sharpest price declines on the market, creating negative equity issues for early adopters and further chilling demand. Long-term, the EV surplus signals a necessary market correction. It's likely to force automakers to rethink product mix, improve consumer education, and retool incentive strategies. Some may pivot toward plug-in hybrids as a transitional compromise, while others may consolidate offerings or delay upcoming EV launches. In the meantime, the EV glut is more than just an inventory problem. It's a drag on overall market momentum, pricing dynamics, and investor confidence in the auto sector's next phase. From showroom floors to corporate boardrooms, there's a growing sense of unease rippling through the auto industry, and insiders aren't sugarcoating it. In recent interviews with franchise dealers, auto analysts, and former executives from Ford and GM, a consistent theme emerges. The American car market is in serious trouble, and what we're seeing now may only be the beginning. One veteran dealer in Texas admitted inventories piling up, customers are walking away mid-negotiation, and we're bleeding on every unit we sell. Another regional GM rep revealed that corporate is pushing volume targets like it's 2021, but they're totally disconnected from what people can actually afford. Behind the scenes, automakers are quietly pulling back production targets, slashing EV advertising budgets, and pushing more incentives to dealerships to offload excess inventory without publicly acknowledging just how severe the slowdown has become. Insiders say the problems run deeper than high interest rates. Consumer fatigue, loan delinquencies, and a flood of overpriced trims no one asked for are clogging the pipeline. They built the wrong cars for the wrong economy, says a former auto retail strategist. Many believe the market needs a full reset. Smaller, simpler, more affordable vehicles that meet post-pandemic consumer priorities. But while some automakers like Honda and Toyota are beginning to pivot toward compact hybrids and lower-cost trims, others are still betting on large SUVs and luxury EVs, chasing margins that no longer match the moment. There's also a growing rift between media narratives and ground-level reality. While headlines tout strong EV adoption and consumer resilience, insiders are whispering about unsustainable lease buybacks, automaker cash burn rates, and quiet dealership closures in rural markets. Rumors of mass layoffs at Tier 1 suppliers and dealership network consolidation are circulating in industry circles, but haven't fully surfaced in the press yet. So, should you buy a car right now? Most experts say no. Wait it out, advises one Detroit-based analyst. There's too much inventory, prices are softening, and real incentives are coming. Just not quite yet. For consumers paying attention, patience could pay off in thousands saved and better choices ahead.